Well, several top policy priorities in President Biden's agenda seek to pay for the government's lavish spending during the pandemic, and whereas it may have been needed as the debate moves to Capitol Hill, the president's additional spending ambitions have really surprised in magnitude. In fact, small business policy experts now really smell trouble brewing, and Main Street, that's you and me if you're a business owner, could really become a financial casualty in several important respects at a time when many operations are just getting back on their feet. Now, this is not really meant to be a political statement. I try to be neutral on this channel for the most part. And so since this is the Business Guy channel, and I'm the business guy, the purpose here is simply to discuss business taxes and whether or not that would be good or bad for the economy and you and me in particular. Now, new business formation data is really heading in the right direction. And I should know, as we have one of the biggest company formation firms in the country. In fact, there is a 110.3% increase in the number of business applications from April 2020 compared to April 2021. And that growing number of new businesses is a huge signal of confidence in the economic recovery. Now, Karen Kerrigan, who's the president of the Small Business and Entrepreneurship Council, said the foundation is established for a great economic recovery and bounce back to pre-pandemic levels. But toying with the tax rates at a time like this has a dampening effect. In fact, one of the highest profile proposals from the Biden administration include a corporate tax rate from 21% to 28%. So let's go ahead and take a look at how this could play out on the world stage. Okay, now the average state corporate tax rate is 4.66%. So you take the 28% federal tax rate and add it to the 4.66 state tax rate and you get 32.66%, okay? In New Jersey, the corporate tax rate is 11.5%. So add that to the 28 and you have 39.5% corporate tax. In China, it's only 25. Great Britain, it's 19. The EU average is 21.7%. And according to taxfoundation.org, the worldwide average for corporate tax is 23.9%. So how in the world are we going to compete? The American Enterprise Institute says the average corporate profit is 7.9%. Now think about that. If we take the China versus U.S. corporate tax rate, averaging 32.66% in the U.S. and 25% across the board in China, that's 7.66% difference. Now you take the 7.9% profit of the average corporation and subtract the 7.66% difference in corporate tax rates between the U.S. and China, and that's 0.24%. So what that means is if a certain corporation in China is making a 7.9% profit, if we sell that same item, all things being equal for the same price, in the U.S. we'd only make a 0.24% profit. That corporation wouldn't even make a 1% profit. They'd make less than 1/4% profit, item for item. China versus New Jersey, 39.5% tax in New Jersey, including federal and state, minus 25%, which is the tax rate in China, that's a 14.5% difference. If that company in China made the same profit margin that average U.S. corporations make, that U.S. company in New Jersey would have a loss of 6.6% in order to be competitive. In Great Britain, the average corporate tax rate is only 18%, and that'll be moving to 25% in April of 2023, so they have a while to pay for pandemic relief. So in 2023, it'll be about the same as competing with China. They'll eat our lunch. And right now at 18%, they do eat our lunch. Now, as we said, the EU average is 21.7%. If the average in the US is 32.66%, that's a 10.96 increase in the profits for an EU company compared to a US company selling the item for the same price. So in other words, we need to produce something for almost 11% cheaper in the US to sell it for the same price. Let's go ahead and take a look at the largest companies in the United States by market cap. We see Apple here, we see Microsoft, we see Amazon, Alphabet or Google, and Facebook. Those are the largest companies by market cap in the US. Of course, in China, they hack into our computers and steal our data and use our information. Now, the competitive companies with these here in China are Huawei, which makes cell phones, China Mobile, which is their state-owned cell phone company, and they have about the highest number of software engineers of any company in the world. Alibaba, which is China's equivalent to Amazon, Baidu, which is their Google, Tencent, which is equivalent to their Facebook. They have social networking and so on. They have QQ and WeChat. So for just about every major company in the US, China has a rough equivalent. This one happens to be booze. They must like their booze. A bank and another bank. So what do we need to do in the US? What's the solution? Well, first of all, we have to stop spending so dang much. As we all know, the government overspends our money. We have to stop going into debt. I mean, the rest of us can't do that. We have to stop giving away our money to other countries. Hey, politicians, we are the most in-debt country in the world. We can't afford it. And who knows, maybe like CEOs and other business leaders, we need to tie politicians' salaries to the national debt. So the key thing is 21% to 28% is not doable on a competitive level. We show the math doesn't work. It'll kill our stock market. It'll kill our pension funds. It'll kill incentives to make things in the US, and it'll send our jobs overseas. So that's my 2 cents worth. Please comment below and let me know what you think. And if you like this video, please click like below, subscribe so you get notified when new videos come out. Thanks for watching. This is The Business Guy.